Good morning, students. Today we will do stockholders equity. Last two classes we had seen what are the journal entries we need to pass when US corporation issue stock. What are the accounting entries we do when company buys its own stock at the time of repurchase and immediately cancelling it. Some companies, in order to reduce the number of outstanding shares, they purchase their own stock and hold it. That is known as treasury stock. We have two treatments for that, right? And then we have seen different types of dividend treatment as well. Like we have stock dividend, we have liquidating dividend, right? So today we are going to do MCQs related to this particular topic, right? So let us see the first question. On December 31st, 20x1, Eagle Corporation reported 17,50,000 of appropriated retained earnings, right? So this is my appropriated retained earnings. Now this earnings I have appropriated for the purpose of construction of new office building, right, which was completed in 20x2 at a cost of 15 lakh. So appropriated retained earnings are how much? 17 lakh 50. And what is the cost of construction? 15 lakh. In 20x2, I have again appropriated 12 lakh more, right? I have again appropriated how much? 12 lakh more. Also, 20 lakh of cash was restricted for the retirement of bonds due in 20x3. Right? So in 20x2 balance sheet, how much Eagle should report as appropriated retained earnings? Right? Now, first of all, x1, right? What entry I pass? Retained earning, unappropriated debit, right? And we had done retained earning, appropriated credit. How much? $17 lakh 50, 17 lakh 50. This is what I have done. Now, in 20x2, 15 lakh I have spent for this new office building. So the entry is reversed. I have already told you. When the purpose for which you are creating your reserves, you are appropriating your retained earnings, right? So unappropriated will decrease and your appropriated retained earning will increase. Now when you have spent that money, so this entry is reversed. So as of now, what is your appropriated retained earning balance? 0. As of now, what is your appropriated retained earning balance? It is 0. Yes or no? The amount of cash which you have restricted for the retirement of bond, this is not a part of appropriated return earning. This is cash restricted. It will be shown separately. Remember FAR 2.1, cash and cash equivalent. Over there I had told you cash is unrestricted for general purpose use and some cash are restricted for retirement of bonds. Retirement of bond means redemption of bond. So that we need to show it separately. So restricted cash will be shown separately from unrestricted cash. Now whether it should be shown as current asset or current non-current asset, it depends upon for what purpose it has been restricted. So this is completely not a part of appropriated return earning. So whatever appropriated return earning that you created in 20x1, the purpose is already over. So you reverse that. Right? You reverse that. Clear? This cash restricted will be shown as current asset. It is not a part of appropriated return earning. So after this reversal, what is appropriated return earning balance? 0. In the current year, 12 lakh more. In the current year, 12 lakh more I have appropriated for construction of new plant. So this is my appropriated return earning new balance. Yes or no? So option A is correct. Option A is correct. Right? Right? Question number 2. A corporation issuing stock, right? I am issuing stock. Clear? Now, when do you charge retained earnings? Listen to me. If I am issuing shares for cash, what is the entry? Cash debit, common stock. If it is issued at more than, then we do additional paid in capital, more than par value if it is issued, right? So this is $15, this is 10, this is 5. Now in case of stock dividend, I have already told you it's a free shares given to the existing shareholder. So what do? You do retained earnings debit, common stock, additional paid in capital, because this stock dividend is issued at the rate market value, and market value is usually more than the face value. Suppose market value is 21. So this is $10, this is $11. So when do you charge retained earnings for the market value of the share? At the time of stock dividend. In ESOP, what happens? Some amount is taken from the employee. Once the option is vested, we will take some money from the employee. Right? Business combination, we purchase asset and liability. In lieu of that, we issue shares. We never debit retained earning for the market value. Stock split, this is capital getting converted into capital. Higher denomination capital is getting converted into smaller denomination capital. So this has to be the answer. Is it okay? Next, number 3. This is equity section of this company. What is this equity section? We have a common stock, 10,000 common stock, 30 is the par value. So when you multiply, you get 3 lakh. Additional paid in capital is 150. And we have retained earning deficit. So basically it is indicating loss. Now this loss the company has suffered not in 1 year, over the years, right? So in this particular scenario, in India we call it as restructuring, reconstruction. And it's a sort of internal reconstruction we will do, wherein we will try to eliminate this loss from the balance sheet. When a company is suffering loss, what option you have? Either you shut it down, or else what else you do? You try to revamp it. And any kind of medical treatment, when you are going for it, it involves some cost. Right? So I need some money for it. I have incurred series of losses. Now I have new idea, new innovation, something new in my mind. I need to revamp my company. I want to give a fresh start to my company. So with this given balance sheet, no one will be able to give you loans. Will you give loan to a company who is having series of losses? No. So some kind of internal reconstruction you have to do. That is quasi reorganization. Now what happens in this particular quasi reorganization? What happens? You tell your common stockholder, equity shareholder, that see, if I liquidate today, you are not going to receive anything. That is for sure. So it's better you reduce this par value. You reduce this par value to $5. So as a result, what will happen? $25 into 10,000. My equity will reduce by 2,50,000. Now, equity is ultimately a liability for the company. If equity is getting reduced by 2,50,000, there is a profit in the books. That profit will be used to mitigate or to eliminate this particular loss. Right? January X5, by reducing the par value to $5 and eliminating the deficit, now immediately after reorganization, what is your revised additional paid in capital, they are asking you. Right? So now what happens, I'll tell you. Common stock $30 debit. How much? Total is $3 lakh. Common stock $5 credit. How much? $50,000. The difference is additional paid in capital credit. Right? So this is basically what? Reduction of capital. I have reduced the capital. I have taken from you the old certificates. I have issued 10,000 shares, par value is 30. Now each one of you will be having the share certificate. Over there it will be mentioned your name. Dear investor, you are holding 100 shares. Dear investor, you are holding 500 shares of rupees $30 each. Now I'll tell you to give that certificate to me. In exchange, you are holding 100 shares, you are holding 500 shares, everything is same. But I am giving you $5 share. It hardly matters for you. Because anyway, equities face value is just to divide the capital. इक्विटी का जो फेस वैल्यू होता है खाली कैपिटल को डिवाइड करने के लिए होता है. ऐसा कहीं है क्या? Is it written like this? That when if you have paid 30, then I'll return you 30. It can be more than 30, it can be less than 30. So you can make 30 to 0, you can make 30 to 5, no problem from my point of view. And even if I tell you that what you have done, I am against this proposal, then company doesn't have any option apart from liquidating it. With the lost hope, it is better to live with a smaller hope. Right? So this old capital is debited, new capital is credited, difference is additional paid in capital. Now, what next? This loss will be debited to additional paid in capital debit. Retained earning loss credit, how much? $210. Now this particular scheme requires proper approval of the court. The company simply cannot go approach its shareholder and do it. Like in India, you need to apply it to the High Court, and accordingly High Court will approve this particular a reconstruction scheme. Basically, you are restructuring your balance sheet. You're telling someone to waive, and you're using that benefit to mitigate, to reduce your loss. Now, how much was there in additional paid in capital opening balance? 150. How much you transferred? 250. How much you used to mitigate loss? It's not about mitigating, it's about eliminating loss. 210. So what is the revised balance? 190. Is it okay? This 4 we will do later on. Number 5. Now I have issued common stock 1000 shares at the rate $20. Preferred stock 1000 shares at the rate $20. Now if I see the par value, it is coming to 20k, it is coming to 20k. So total consideration is 80k. It means what is the additional paid in capital? 40k. Currently this is selling at 36 per share and this is selling at 27. Right? So what is the fair value? What is the fair value? If I calculate fair value of common stock, $1,000 into dollar 36,000. Preferred stock 1,000 into dollar 27. Sorry, preferred stock is 2,000. Sorry. Now the ratio is 4:6. So divide this consideration in 4:6 ratio. So 80,000 into 6 by 10. 80,000 into 6 by 10. That is 48,000. If I see par value, the total par value is 20,000 for common stock, 40,000 for preferred stock. Right? That totals up, but the consideration received is 80,000. It means I can easily make out that there is additional paid in capital. But I need to divide the proceeds. So it's very simple. Allocate on the basis of fair value. Basket issue of purchase, basket issuance of shares. Right?